Welcome to this explainer. We are jumping right into the SASB Real Estate Services Standard today. We're going to look closely at the documentation to see exactly how going green isn't just about environmental responsibility anymore. It's actually become a major, measurable driver of financial growth in the real estate industry. So if you want to understand the modern business of buildings, you are absolutely in the right place.
But before we get into the weeds of accounting codes and sustainability metrics, let's ask a fundamental question, one that really sits at the very heart of this entire standard. Can a sustainability rating actually increase a building's value? Like, what does a green building actually do for an owner's bottom line? Well, as we'll see, the answer is a resounding yes, and the framework for tracking it is incredibly rigorous. Here is our roadmap for today. We'll start with the real estate impact, move into key sustainability services, look at the financial payoff, learn about measuring sustainable success, and finally, finish up with trust and transparency. Let's kick things off with Section 1, the real estate impact. Okay, so the baseline reality here, and the reason this framework exists in the first place, is that buildings and the everyday activities happening inside them are massive drivers of global resource consumption. The scale is honestly staggering. We're talking about immense energy consumption, heavy greenhouse gas emissions, tremendous water usage, and just vast amounts of waste generation. Because that footprint is so incredibly large, the opportunity for real estate services to step in and make a difference is equally huge.
That brings us right to Section 2, Key Sustainability Services.
This is what going green actually looks like in practice. The standard outlines the precise services property managers provide to clients. And we aren't talking about basic janitorial work, right? We're talking about highly targeted resource efficiency, things like utility data management, which allows owners to track exactly where their energy is going. There's strategic energy procurement to make sure they're buying power efficiently. Energy and water benchmarking lets a building compare itself against the broader market. And of course, securing vital sustainability certifications. To cut through the industry jargon a bit, these services usually revolve around achieving globally recognized certifications. Think Energy Star or LEED. These aren't just shiny plaques you hang up in a lobby. They act as rigorous third-party audits of a building's efficiency. When a real estate service provider helps a building achieve an Energy Star rating, they are providing a highly valuable service that basically proves the property's environmental performance to the rest of the market.
Let's move to Section 3, the financial payoff. This is arguably the most crucial part of our explainer.
The big takeaway here is that those sustainability services directly impact the balance sheet. The first massive financial benefit is improved asset values. When a property manager implements rigorous utility data management or secures a certification like LEED, the building inherently increases in value. It becomes modernized, it's future-proofed against environmental regulations, and it becomes incredibly attractive to premium investors. Second, we see a direct link to increased tenant demand. Put yourself in a corporate tenant's shoes for a second. Companies today have really strict carbon reduction targets. By offering spaces optimized through strategic energy procurement and proven sustainability certifications, property managers directly accelerate leasing velocity. Plus, they drastically improve tenant retention over the long haul.
Third, and honestly the most immediate benefit, is decreased operating costs. When you aggressively manage utility data, benchmark water usage, and optimize energy procurement, your day-to-day bills just plummet. You're using significantly fewer resources to run the exact same square footage. For a large commercial high-rise, even a 10% reduction in energy consumption is a staggering amount of money saved year over year.
All right, Section 4, measuring sustainable success. If the payoff is that huge, how are we tracking it?
The actual SASB documentation for sustainability disclosure topics and metrics shows exactly how this is tracked quantitatively. We aren't relying on vague greenwashing here. The standard demands standardized accounting metrics so investors can compare one real estate company directly against another.
The framework uses specific accounting codes to mandate disclosure. For instance, companies literally have to state the exact revenue they're generating from energy and sustainability services. Next, they have to disclose the physical footprint, meaning the floor area in square meters and the actual number of buildings receiving these services. And finally, they must disclose the footprint of buildings that have successfully obtained those coveted energy ratings. It paints a complete picture of their sustainability operations.
But there's a really important catch here we need to understand. These metrics only apply to floor areas where the real estate owner has what's called operational control, meaning the owner actually has the real-world power to introduce and implement these green policies. If they just own the building on paper, but the tenant controls all the operations, they can't take credit for those services in this disclosure. It ensures the data reflects actual manageable impact.
Finally, let's transition to our last section, trust and transparency.
Here's the thing. This entire machine runs on one single component, client trust. If investors and tenants don't trust the property managers, the whole system grinds to a halt. The standard highlights that services like brokerage and appraisals carry a particularly high risk for conflicts of interest. Take a dual agency transaction, for example, where a firm represents both the buyer and the seller. Because the risks are so high, there's a strict requirement for robust employee training, tight oversight, and transparently disclosing any potential conflicts of interest. It's a pretty stark contrast. Implement strong governance to manage these conflicts, and you build lasting client trust and long-term revenue. It literally protects the asset. But fail to do so, and you're looking at devastating regulatory fines, severe damage to client relationships, and a rapid loss of market share. In real estate, professional integrity is a highly tangible financial asset. To keep everyone honest, SASB requires tracking some highly specific governance metrics. Companies must disclose the revenue generated from those high-risk dual-agency transactions, plus any revenue tied to appraisal services. Most importantly, they demand the disclosure of any actual monetary losses resulting from legal proceedings associated with professional integrity or negligence. This makes sure that any ethical failures are immediately visible on the balance sheet. And keep in mind, this rigorous standard isn't just some niche guideline. It is globally recognized. The integration with the International Sustainability Standards Board means these metrics are now a core part of the global financial reporting landscape, heavily relied upon by investors all over the world. So, as we wrap up this explainer, I want to leave you with a provocative thought. The next time you walk into a commercial building, will you just see concrete, steel, and glass? Or will you see a complex financial asset whose market value, tenant appeal, and operational costs are completely, inseparably tied to its environmental footprint? The standard makes it clear. In today's market, sustainability and profitability are one and the same.